Hi there. Welcome to another episode of Wizard of House by Mr. T. And I am Mr. T. And today's guest, I've actually have the pleasure of finally meeting Seth Jones from Movement Mortgage. And how I met this gentleman is through a couple of transactions that we did together. I had actually two buyers that I referred. Basically, I have a pool of lenders, mortgage originators, or they call them loan officers, whatever you have, they're the same thing, loan officer and a mortgage broker. And Seth really impressed me, Seth Jones, and the two transactions that I just recently did with him. The first one, the buyer told me, who's a friend of mine, the buyer said, "Oh, I'm going to use Seth." And I'm like, "Who's Seth?" And Seth jumped in, and he's actually has his own branch here in Port Orange. I'm going to introduce you to him, and then we're going to just go through some, things that are happening with the market, the mortgages, the rates, and everybody wants to know what's happening with the rates, because the Fed is talking about raising them, but we're still going to be at the beautiful rates. Even if they ever had 5%, it's still beautiful. Because my first home, everybody, I paid 13%. That kind of tells you I'm from the 90s, so 80s, 90s. That's when I bought my first home. Seth, welcome.
Thank you. I really appreciate the opportunity to be here. Pleasure to finally meet you in person.
Thank you so much.
Yeah, so I basically have a mortgage office in Port Orange, Movement Mortgage. It's myself and my brother, and we do pretty much every type of lending, and I'm happy to answer any questions that you guys have today.
Yeah, we appreciate you making the time to come here and do this with us. What I'd like to just get a general idea from you, where you think the rates are headed. What do you think it's going to do to, buyers out there, even sellers? And what is your advice to them? And also, if you're a buyer thinking of buying or in a process of preparing to go meet a lender, and please feel free to announce your phone numbers and how they can reach you or your website. What do they need to do to build their credit or to get a better rate or, to get a better deal? What makes your company better than other companies, and the process, what things they shouldn't do. Mm-hmm. So just start with, what do you think is happening to the rates and what the Fed is doing and on and on. And I appreciate it.
Oh, yeah, absolutely. And right now, interest rates are something that I've talked to a lot of people about, and really everybody's curious because really since the beginning of the year, we've seen a shift of almost a full % on the interest rates. I mean, in October, we were lending conventional 30-year mortgages, which is essentially a traditional mortgage, a typical mortgage, at 2.99%. Well, fast forward to today, and some people aren't even aware that they're this high. I shouldn't say high, as you mentioned. This is all relative because high rates today are historically very low. But we are looking at rates that are significantly higher than they were a few months back. And today, the average 30-year home loan is roughly 4.125%, depending on circumstance, obviously. And there's a lot of factors that drive interest rates. Right now, we're in a market, obviously, as you know, where supply is causing...
Yeah, tell me about it.
Right. We have such a constricted supply that prices are climbing. And that this is one of the things that people are talking about when you hear the word inflation. Homes go up in price. That is a factor in inflation. Cars go up in price. That's part of inflation. Groceries go up in price. That's part of inflation. Mm-hmm. So the Fed is concerned about inflation, and the Fed wants to tamp down or slow down inflation. And really, the biggest lever that they have in order to impact inflation is controlling or manipulating the Fed funds rate, which is essentially the rate of interest that they're charging institutional lenders to borrow from them. So mortgage lenders, in an easy way to sort of understand this, is mortgage lenders generally aren't lending out all their own money. They'd run out of money so fast. So they're borrowing money.
Exactly.
When they can borrow money for free, they still have a whole operation to support. So they have to make money in order to lend. So they have what's called a margin. So anyway, long story short, the lower the Fed funds rate, the lower mortgage rates. The higher the Fed funds rate, the margin's going to essentially stay the same, the higher mortgage rates go. So the Fed wants to slow down the real estate market a little bit because that would be considered healthy. I mean, multiple buyers, it's great for sellers.
Or the borrowing, basically. They want to slow down the amount of debt or people are taking on.
Well, yes, they want to slow down debt, but they also want to slow down the price acceleration because it's shooting, and easy money makes the price acceleration that much hotter. So that's where the Fed comes in. And because you will see news articles that were recently put out by CNBC and CNN and the other major media outlets that talk about the Fed's recent announcements in regards to raising the Fed funds rate multiple times throughout the year. And we're probably looking at a situation where the interest rates are going to climb a little bit more than what we originally anticipated. I mean, I don't think a lot of people expected to be at 4.125 this early in the year.
Yeah.
So really, we don't know exactly where the rates are going to go, but what we do know is that the current outlook is already baked in. So what I mean by that is the market's already reacted to everything that the Fed has recently announced. So the 4.125% interest rates that we're seeing right now, unless things get substantially worse in regards to inflation, we're probably going to see a stabilization of interest rates. So I wouldn't be too worried about rates climbing significantly unless you start to hear headlines that talk about the the federal funds rate raising significantly, and that could change that dynamic.
So, these are all great points, and I'm surprised it actually went over 4 already. Like many people, they still, I talk to people, they're saying that they get, the rates are still, 3, 3.5, 3/4. Where do they get these numbers? Like if you go open a paper and they have all these banks with the different rates. So, as a buyer, you get confused. One person is saying the rates are 4.125. And then somebody says, oh, yeah, we can get you a loan at 3.5% with a half a point. So just tell me where all these rates are coming from. I mean, if a buyer is shopping, they're going to go for the lowest rate. Like you can go online, you got guaranteed rate, you got, all these other online Quicken loan. Where is the real rate? I mean, explain that.
Absolutely. And that's a great question. And I'm glad that you brought that up because there's a big difference between real interest rates and advertised rates. So a good resource and a resource I highly recommend to everybody that would listen to this is Mortgage News Daily, because the majority of rate information comes from rate surveys. So when you're hearing 4.125, that's not necessarily a movement thing. That's not any particular...
meaning your company.
Exactly. Yeah. That's not any particular company. That's based off of a rate survey of the largest national lenders and what they're presently offering at no cost. And that's an important point because you had mentioned points. And many times you'll see advertisements. Like, for instance, and this is where a lot of confusion comes from. If you hear what I just said at 4.125, and then you go to lendingtree.com, and you'll see 4 or 5 lenders that are advertising, 3.2, and you're like, this lender right here is going to offer me 3.2.
Exactly.
So you're wondering, every borrower wants the lowest possible rate, and that makes perfect sense. But the reality is that and this is what I advocate for everyone, get multiple quotes. It's part of the business. I mean, we're in a business that is, when I say I'm in the mortgage lending business, and I know that you've had conversations in regards to commission, but in regards to the business I work in, if you're not offering at least extremely competitive rates and extremely competitive terms, then you're just not going to be competing for very long, because it's a very price sensitive business. So where I was going with that is, you're going to see big disparities in the advertisements, but there's very rarely any big disparity in the reality of pricing out a real scenario. So what I mean by that is, let's say somebody has 640 credit and they've been working a job for a while and they're hearing different things and they want to see what they can qualify for.
Right.
If they go to lendingtree.com, they're going to see 3.4%. And then they're going to see a couple little disclaimers to the right of it that talk about the APR and how many origination points that are there. But most uninformed, or I shouldn't say uninformed, but most first time, or even not first time, most people that aren't in the industry,
They just see the rate.
Yeah, they just see the rate and they're focused on that. And yeah, they want to make sure the other numbers aren't too high, but that's not the primary focus.
So basically, folks, what he's saying is the rate is not the realistic thing you're going to get hit with once you actually apply with the lender. This is where you want to make sure your lender, your mortgage officer, whoever it is, whether it's movement or not, they're transparent with you, and that they're not doing a bait and switch tactic. Like they'll advertise a 3.2 and you get to the closing and it's 4.2, or it's 3.2 and you're like, why is my closing cost 20 grand?
Right.
Oh, well, because they charge you 2 points and you're borrowing 400,000, and 2 points of 400 is 2 times 4 is 8 grand. Am I right? Something like that.
Yes. Yeah. And for any listeners, a point is a fancy way to say 1%. So a point is 1% of the loan amount. And then other origination charges, and I just did air quotes because what an origination charge really is just a charge that the lender is passing on to you to essentially make sure that they're hitting their profit goals. So it makes it a lot easier for a lender to offer a really low rate if they're charging you more money up front. And that's where people have a hard time is, it's a big difference to get offered 4.125 at no cost or 3.5 at 2 points. So for anybody out there that's listening, well, which is better? Should I do 4.125 or 3.5 with 2 points? Well, there's a sort of a simple formula that you can go through to help educate yourself. And the formula is you take the cost of the points or the origination charges. So anything that the lender themselves, not third parties, we're not talking about title costs, we're not talking about inspections or anything like that, only origination charges. And actually, if you're looking at a loan estimate, it would be in Section A. Section A on a loan estimate is the section lenders control.
Yeah, so by law, they're supposed to give you what we call a GFE, right? A good faith estimate.
Yes, they've changed the name of the form, but it's
now. Go ahead and say.
They're just calling them loan estimates now, and the primary reason they changed some things around in the way that things are disclosed. But the bottom line is, you should be getting a form that outlines. It is essentially a good faith estimate that outlines all of the costs associated with the prospective loan. And those are going to have different cost sections, and it'll have A through, I believe, H on the closing cost sheet. And A is the first one that you're going to see, and it's the one that lenders control. But to quickly elaborate on the formula, you take the total of Section A, and then you take the rate. And if you're looking at another one, you take the total in Section A and you look at the rate. and you look at the difference in payment, and then you divide the difference in cost by the difference in payment.
Can you give me a quick example, kind of? Just go with a round number real quick.
So let's just, and this is all hypothetical off the top of my head. So, bear with me, the math's probably not going to be 100% correct. But let's say someone's buying a $300,000 home, and they're buying it with a 4% interest rate. And they're shopping around and they find somebody else that's going to offer them a 3.75% interest rate, but they're going to pay a point for that.
Yes.
So, and this is something that actually makes sense. This is close to what you're probably going to see. So 1 point on a $300,000 loan is $3,000. So the 4% interest loan does not have a point. The 3.75% interest loan does have a point.
Does have a 3,000.
The 4% loan, let's just say hypothetically, it costs you $1,500 a month. The 3.75% interest loan, let's just say hypothetically, costs you $1,400 a month.
Exactly.
So you would take the $3,000 difference, divide it by $100 a month. That's 30 months to break even on the additional cost. So then the smart thing to do, if you're comparing and it's a different lender, would be to say, I'd like to see your estimate with a point, please. So that way you're comparing apples to apples. You're saying to the lenders, let's match your costs.
Right. So you take the 4% one, say, hey, you do it with a point.
Exactly. Match, let's line these costs up, and that way you know truly which estimate is better if there's any real difference.
So 1 point buys you 0.25%, am I right? Or is it different?
Generally speaking,
Generally
speaking, that is approximately the way that it works, but it's not an exact translation. So sometimes it'll buy a little less, sometimes it'll buy a little more.
Does that help someone to get qualified? Let's say I have cash, but I can't really go over a certain thing and the rate. I need to lower the rate a little bit so I can get qualified.
Certainly.
But it's going to cost me $3,000 more at the end to bring to the closing.
Absolutely.
My cash to close will go up.
Certainly. And I see this a lot with retired individuals that have assets, but also have a lower fixed income because they can control their payment a lot more. They're not going to earn a lot more money, but you can put more down and you can buy your rate down to have a smaller monthly payment.
So, this is where I want to tell our beautiful fans of Mr. T, the listeners, I've been doing real estate for 20-something years, and I'm going to tell you this. I go to a seller's house and to list their home or whatever, and the seller says, I'm going to tell you up front, I'm not paying their closing costs. I'm like, what are you talking about? So the seller thinks buyer has no closing costs, but, that they're going to sell the house. So, folks, the term closing costs can be pretty broad, pretty confusing. So in Florida, the seller automatically pretty much, we call it customary and ordinary, has almost a 2% closing cost. That's stamps on deed, title insurance, and a lot of other junk fees, as I call them. It adds up to almost 2%. To be exact, I'm like at 1.7. So I always tell my sellers, listen, no matter what you do, whether you pay closing costs or not, it's going to cost you because the buyers in Florida are all used to seller paying for stamps and title. And we can discuss stamps, title, all that later. But a seller has their own 5-6% or whatever is the commissions plus a 2% closing cost. Now, when seller tells me that, I say, sir, a cash buyer doesn't have any closing costs, but most buyers are borrowing money, and a buyer has closing costs. And how do you determine like if I'm buying a $300,000 house, I tell people, if you're putting 10% down and it's $270,000 loan, expect like 2% of the loan amount to be 2 to 3% to be your closing costs.
Right.
Or maybe more. If you're buying $300,000, I tell them save up to $10,000 for closing costs.
And that's a great recommendation. Normally, And this is something that we've adjusted over time, but especially because property taxes and insurance have been raising a little bit in the area. I used to say 2.5%. Now, over the past just really 2 years, I've been telling people 3.5% in terms of total closing costs. And a reason for that is that a big part of your closing costs are your property taxes and your homeowner's insurance. Now, no one has any control over the property taxes, but you actually get to choose your homeowner's insurance. Some people, whenever they're thinking about buying a home, they don't realize that those are considered closing costs, but everybody knows that they're going to have to pay property taxes and insurance.
Prepaids and closing costs. So prepaids are, you got to pay 1 year of your homeowner insurance right there at the closing or when you secure your insurance. That's called a prepaid item, as far as I
Yes,
know.
Absolutely.
And then they will, depending on the time of the year you're closing on a house, guys, if your tax bill on the house you're buying, which is going to change, obviously, if it's right now $4,000, the title company is going to take 3 to 6 months of that and put it in your escrow. So that's another major amount.
Exactly.
It's like $2,000 right there. So,
certainly.
So there you go. You have that plus this, and 2,000 insurance, 2,000 escrow. There goes $4,000.
Right.
In your escrow.
Once you said that, that made perfect sense. Because whenever I said 3.5, I was estimating roughly 2 for closing costs and then 1.5 for prepaids. Because many times buyers don't differentiate that; they just want to know how much they're paying at closing. So I appreciate you pointing out that.
Sure. Yeah. This is where, I've been at hundreds of closings, and we get sellers come with their agent, or I'm on the other side with my buyer, and the seller is signing and sees, why am I paying for this guy's title insurance? What is all these fees? Because no one told the seller, hey, I'm listing your house today at this number. If I get full price, here's what you're going to net. And, hash it out up front with the seller. So a lot of times the same thing happens with the buyer. The buyer goes online, fills up an application. They got to put 5% down, 10% down, 3.5% down. And then on top of that, nobody tells them you're going to need another $10,000 or 3% cash to close, as we call it, so all of that can get overwhelming, but again, my experience with Seth has been wonderful. I've had buyers that went and called like 2 or 3 lenders themselves, and then they called me, said, Lee, do you have anyone? And I introduced Seth, and they dropped all those people and went with Seth, and they are very happy with him. So I can't say enough about you, because, as an agent, we are scared to recommend anybody unless they prove themselves to us. And not that, it all depends also how transparent the buyer is with the lender. Some buyers leave stuff off of their applications. And my advice is don't hide anything. I tell the same thing with my sellers. Hey, if you had a leak in your house, you better be transparent up front, because the neighbor, somebody's going to come up and say, hey, that house had mold. Did they tell you? That house had a leak. Or you go get insurance. The buyer gets insurance. They say, oh, there was a claim on that house. So you want to be transparent as a seller, as a buyer, when you're filling out an application. Put everything on there. If you have a child support, in another state, whatever, they're going to know it. They have what they call right now, and tell me if I'm right, they have some kind of forensic background check now for buyers. And of course, I got in an argument with another lender, but they had actually made a mistake on that forensic. And they told the buyer, you did not disclose your name is on this property. She's like, I'm not on that property. And they said, yes, you are. And they said, no, you're not. And there was a big, and then the lender finally, I actually had to get involved and prove to the lender that they're wrong. Because I pulled the deeds. I called the title.
Right.
The title pulled the deed and told the lender, "You're wrong. She's not on there. That's just a mailing address." So anyway, anything you can, elaborate on that as far as people when they make an application, what is a preferred score that you like to have? What kind of, not everybody's perfect. They miss payments here and there. What is where you say don't even bother applying, call Seth, he will tell you what you need to do to get your credit up. What are the scores that you guys are looking for, or what basis? Any advice to anybody out there?
Absolutely. Before I talk about the credit scores, I want to just touch base on one thing that you had mentioned, and it's essentially the transparency aspect. And for me, I think that probably the most important thing when you're working with a lender is to make sure that you're working with somebody that when you're in communication with them, you connect with them and you can trust them. Because it's going to be critically important to have an open dialogue and understand that when you're working with a good lender, they're on your side, and hiding things, as you mentioned, there's a system called data verify. These things are going to come up. It never makes sense to hide anything. So you want to, if anything, overshare, because the lender, the individual you're talking to, they're not going to include unnecessary information in your application, but they're going to filter everything that you tell them and put in the important details of what they need to know for a loan application. And then they're going to be able to better advise you on your best path forward. Because if you're not communicating all the details, then we may be missing a critical piece of information that's going to help us get you the best deal possible. So that's the first thing. And then in regards to, to go to credit scores, that type of thing, really, if you're below a 580 credit score, there are people that talk about getting loans under 580. Realistically, at that point, you need to be focused on strictly doing credit repair. 580 below, credit repair. 580 to 600, you need to either have one of two things. Lenders call these things compensating factors. You can get a loan, but you need to have money in the bank. So the more money you have, the worse your credit score can be. It's sort of a sliding scale. So the more resources you have in the bank, the more lenient the lender will be in regards to credit scores. So if you're the typical buyers that have lower credit scores don't have a lot of money in the bank. So for those people, really 620 or above is where you need to be. If you're between 600 and 620, something might be able to be done, especially if you have a family member who's potentially willing to gift some money to help you out with some additional reserves, as lenders call them, which just means having a few months of funds left over in the bank. But 620 or above is really where you want to be. And if you want a decent mortgage rate, you want to be 660 or above. Because once you're below a 660, lenders start to penalize your credit score with a significantly higher rate.
So if the rate is 4.125, they can charge you 4.5. Exactly. So the better rate, guys, the lower payment, the better score. The better score, your credit score, you can get a free annual credit report, right?
Yes, you can get a free annual credit report from all the bureaus.
And where is that website? What was, do you know that one?
Annualcreditreport.com.
There you go. That's the real. Remember, there's a lot of scam, websites. They tell you it's free. You go on there and it's not free. And one more thing, Seth, is a lot of buyers are afraid that their credit gets pulled and their score is going to crash. Oh, I already applied with one lender online.
Right.
I don't want Seth to, so they got soft pull. You can do a soft pull, you can do a hard. Can you explain the effects of those points? I understand it's not much.
Right. It's not much at all. So there's 6 major credit factors. And without getting into all 6, I will say that hard inquiries are the least weighted, meaning they're the least impactful of all the 6 credit factors that impact your credit score. So the more credit you have established, the less it's going to impact you. But in a nutshell, I have this conversation all the time, and you can cross-reference this on the Consumer Financial Protection Bureau, so cfpb.gov. But once you actually pull your credit for mortgage purposes, you have 45 days from that point to have your credit pulled by other lenders. And this is only for mortgages. So it's not for other types of, like it's not for car shopping.
I see.
So it's only for mortgages, but you have 45 days to have your credit pulled by other lenders, and it will only count against your credit as one hard inquiry.
Oh, nice. And how many points would that?
Well, it ranges. So
3 points. I mean, it's not much, right?
Somebody that has an established credit score where they don't have a really thin credit file, meaning it's not new. Like if you're right out of college, it might impact you a little bit more. But if you have been establishing credit for many years, it's only going to be a couple points.
Okay, great. So that's a good point. So if you're seasoned, you already have like an 800 score, you bought 5 houses already, it's not going to affect you much.
No,
But
especially if you're not.
A lot of these young people come and they don't have bad credit. They just don't have credit. They have one credit card. I ran into this lady and she says, my daughter is trying to buy and she's just got one credit. Her car is paid for. She has no rent. She saves. We've told her don't pile on debt. And they just got her one credit card. And I told her she needs to do more. Maybe go get a car or go get, more good payments. Or what payments do you think they should do to build their credit?
So lenders are specifically looking, there are ways around this, but in a nutshell, you need 3 trade lines. So what I normally recommend for somebody that's brand new is get a secured credit card. You're going to be able to get a secured credit card, no problem. Have that for about 30 to 45 days. Within 30 to 45 days, you can get an unsecured credit card as long as you use the card and pay it off.
Okay, and again, what is a secured credit card, real quick?
A secured credit card is whenever you give a credit establishment $300, let's just say, and they'll give you a card that has a $300 limit. So you're basically putting the money in the bank to use it.
Okay, great. And unsecured means they're just basically going by your credit score.
Exactly. So they could still give you a $300 limit, but now they don't require the $300 in the bank to issue you that card.
Yeah, we could sit here and talk to Seth for a long, long time about lending and all the stuff that we have, we've gone through. Now, Seth, you want to tell us, you live in Port Orange? Or
Yes,
where
sir.
do you live? Yeah.
Yeah, actually, I used to live in Water's Edge. I recently moved over to Woodhaven. I got my offices off of Dunlawton.
Congratulations.
Thank you.
Beautiful community there.
Well, thank you.
And you have a family?
Yes, I have a wife and a recently turned 3-year-old daughter, Mila.
Oh, nice.
Yeah.
Excellent. So it's very nice having you here. How do people reach you? What's the easiest way to reach you? Text, phone, website?
Yeah, absolutely.
Just go ahead and, spell
However,
it all out. And
however's most convenient for you, you can text or call at 386-898-8137. You can email me at seth.jones@movement.com, or you can find me online. If you just Google Seth Jones Mortgage, not only will you find my office and my information, but you'll also find some podcasts that I've done and things like that.
great. And Seth was working with another mortgage company. He's with this Movement.
Movement Mortgage, yes, sir.
Out of North Carolina, did you say?
Yeah, it's a large national lender, and really Movement. The reason why I love working with them is not only are they a company that has outstanding products to offer consumers, but they also give 50% of all company profits away. And if you are interested in learning more about that, you can check out the Movement Foundation. But the goal is to build 100 schools in the U.S. by 2030. So over the next 10 years. And already 3 have been built. It's pretty incredible.
So Seth is also a veteran. He does VA loans, folks. He does FHA. He does conventional. You do all sorts of loans, right?
Yes, sir. And one of the things that I pride myself on, I consider myself a one-stop shop, because if I can't do it, I almost assuredly know who can, and I'll point you in that direction.
Awesome. And to reach Seth, you just do the 386 for Florida. and or for this area, not Florida. 898-8137. That's his cell phone. You can call or text him. And then his email is seth.jones@movement.com.
Yes, sir.
Any last advice to anybody out there before we let you go? And again, we appreciate you being here.
Well, thank you. I appreciate you having me. If I was going to give any parting words, I would say that anybody that's listening to this, that's considering buying a home, I wouldn't be scared by the market, because the market is always going to there's always going to be headlines. There's always going to be something that you could be scared of. But at the same time, if you've purchased a home, and anybody that's purchased a home, especially recently, understands the power of appreciation and the power of home ownership. And, in the United States, that's just not going to change.
Yeah, that's a great point, folks. So don't let the rates scare you. There's, I think we are expecting more inventory on the market. That's normal for us around this time of the year, February, March. And, they might try and slow down this economy. Florida has just been, I just did an article, we have unlimited sunshine. So it's bringing everybody, to Florida. So that's one thing. And the last crash was different. I don't see a crash here. I might see a little slowdown. I might see it go down maybe a hair if it does, but I really don't see, because of the supply chain, the labor, the material, the cost, getting those materials from one point to another, making the material. I don't see housing going down, because you try to replace a house right now that you bought 6 months ago, it's going to cost you $50,000 more or more, 100,000 more. So just check the area values. You see they're going up in our area 20-30% a year easily. It's crazy.
Absolutely.
And the sellers, this might not go on forever. I know a lot of sellers are going, okay, if I sell, where do I go? These are all decisions where you reach your agent and, review all of that. And it has to make sense to a buyer. It has to make sense to a seller before a deal can be put together. And I'm also here for you if you guys ever need any advice or call, just text, email. I'm always here for you. And thank you again for being here, Seth.
Thank you for having me.
Don't forget, if you're looking to subscribe to our podcast here, just go to YouTube or any kind of podcasting, or just go to Google and type Wizard of House by Mr. T, and it will just pop right up. You can pick if you want to see it on YouTube or on Spotify or any other podcast platform that you prefer. Thank you again for listening to us.